The U.S. stock market is currently closed, with SoFi Technologies Inc. having last closed on Friday, October 17, 2025, at a price of $26.54, reflecting a modest intraday decline of $0.06 or 0.23% from the prior close. Now here's the surprising detail. While the market narrative focuses almost entirely on SoFi's lending success, particularly in personal loans and the subsequent GAAP profitability, the far more significant and often overlooked development is the quiet but accelerating strength of its technology platform, Galileo. This segment, which provides critical back-end services for other fintech firms and even traditional banks, posted an 81% year-over-year increase in adjusted EBITDA in the last reported quarter. This fundamentally shifts the business from being a high-growth but interest rate-sensitive lender to a diversified, high-margin technology infrastructure provider that happens to own a bank, a dynamic that the current consensus stock price does not fully appreciate. The street tends to treat SoFi like a bank or a traditional lender with a tech veneer, constantly applying skepticism about credit risk and interest rate exposure. But the reality is that the Galileo platform provides a structural hedge and a scalable, high-quality revenue stream that makes the overall growth story far more durable than most investors are willing to admit. The recent price action of SoFi stock has been a story of a substantial rally, hitting a wall of macroeconomic concern and valuation pushback. After climbing aggressively over the past year, nearly quadrupling from its 52-week low near $8.60, the stock tagged a high of $30.30 in late September 2025. Since hitting that peak, the stock has experienced a pullback, trading down toward the mid-$26 range. This movement is characteristic of a highly priced growth stock facing two pressures. First, natural profit-taking after a massive run, and second, a general market fear regarding rising interest rates and the stability of the regional banking sector, which can spook investors even in the case of a digital-only institution like SoFi. We saw a particularly sharp drop in one mid-October session following profit-taking activity, a move that reinforces the idea that, for many short-term traders, the stock's valuation is getting stretched. The average volume remains high, in the realm of 60 to 80 million shares, suggesting strong investor interest, but the intraday swings between the daily high of $26.92 and the low of $26.01 show a clear battle between buyers looking for a dip entry and sellers reacting to the macro environment or simply locking in gains. The high trading volume confirms that this is not a forgotten stock, it is a highly debated one, and the outcome of that debate rests on whether you view the price as too high for a bank or appropriate for a fast-growing, diversified technology platform. Institutional investors are, as expected, divided, which is reflected in the consensus hold rating from the majority of analysts. Out of over 40 analysts covering the stock, the ratings are split, with a significant portion remaining on the sidelines with a hold, while the others are roughly split between buy and sell ratings. This fence sitting reflects the core tension: exceptional growth metrics that should command a premium valuation versus the lingering doubts about credit quality and the ability to maintain profitability in a dynamic rate environment. The median analyst price target sits significantly lower than the current price, a fact that puts the stock's performance in direct contrast with Wall Street's cautious outlook. This is a classic expectation versus reality mismatch. The reality of the stock's growth and momentum has far outpaced the expectations built into analyst models. Recent revisions have been mixed, with some raising their price targets to reflect the company's strong performance, and others maintaining or even reiterating a sell rating, citing the high price-to-earnings ratio of approximately 53.80 as a major sticking point compared to more mature financial peers. What is often missing from these analyst models is a proper appreciation for the capital-light business segments, namely the aforementioned Galileo and the Technisys core banking system. These segments, which allow SoFi to serve other financial institutions, command higher software multiples, which, when properly factored in, could justify the stock's premium price and challenge the overly conservative analyst targets. This underlying technology business is the foundational reason the stock is considered to have very strong momentum by some quantitative scoring systems, despite its high valuation. To properly understand SoFi, we must look at the three-part structure it has painstakingly built. It is not merely a digital bank. It is an integrated financial services platform. The three core segments are lending, technology platform, and financial services. The lending segment, personal loans, student loan refinancing, and home loans, is the largest revenue generator and the engine that drove the recent GAAP profitability. This success has been driven by targeting high-earning, high FICO score customers, giving it a portfolio with a lower-than-average net charge-off rate, which is a key differentiator in the high-interest rate world. The technology platform, which includes Galileo and Technisys, provides account opening, payment processing, and core banking services on a business-to-business model. This is the structural hedge. When lending cools due to higher rates, the fee revenue from this segment is meant to provide a buffer. Furthermore, with its bank charter obtained in 2022, the financial services segment, including its checking and savings accounts, has allowed SoFi to fund its loan originations with low-cost, member-sourced deposits, significantly reducing its reliance on more expensive wholesale funding markets. This internal control over funding costs is the competitive advantage that has enabled 7 consecutive quarters of GAAP net income, a major transition from its earlier periods of net losses. The company's long-term vision is to be a comprehensive financial hub, increasing its products per customer to maximize lifetime member value through cross-selling. The company's past performance reinforces this transition story. For years, SoFi was known for its explosive top-line growth, but struggled to turn a consistent profit, posting substantial net losses. Revenue more than doubled in the 4 years leading up to 2024, but operating costs, particularly sales and marketing, were high as they aggressively acquired members. The strategic decision to acquire its bank charter and integrate the technology stack were key turning points, resulting in the recent string of profitability and the significant rally in the stock price. The end of the federal student loan moratorium also provided a strong tailwind for its original student loan refinancing business, another factor that helped propel the stock off its lows. This historical context is vital. The current valuation reflects the sudden realization that the integrated model is working, that the company is scalable, and that its cost per customer is decreasing. The expectation of a non-profit-making tech company has been shattered by the reality of a multi-quarter streak of GAAP net income. Looking forward, the future outlook for SoFi Technologies is tied to its continued execution on 2 fronts: sustaining lending growth while mitigating credit risk and rapidly scaling the fee-based businesses. The primary catalyst is the upcoming earnings report, expected in late October. The market has consensus expectations for earnings per share, but the real upside potential rests on the company's ability to exceed revenue and EBITDA forecasts, particularly from the non-lending segments. A sustained outperformance in fee-based revenue would provide the evidence needed to re-rate the stock, moving it out of the bank valuation bucket and closer to a technology company multiple. The opportunity also lies in its target demographic: affluent, financially responsible young professionals, a highly sought-after group with high lifetime value. The cross-selling potential remains enormous, growing members from the current 11.7 million and increasing the average number of products per member from the current level are the core drivers for the next few years. However, the risks are substantial and must be considered. The most obvious is the macroeconomic environment. Higher for longer interest rates could dampen loan origination demand and squeeze lending margins, especially if the cost of deposits begins to rise faster than the company can adjust its loan pricing. A major slowdown in the U.S. consumer economy could also increase credit loss rates, challenging its current relatively clean credit book. The second major risk is competition. Traditional financial institutions are not standing still. They're investing heavily in their own digital platforms. Additionally, other pure-play fintech firms are competing for the same customers and technology contracts. SoFi's stock performance over the next year will hinge on whether its cost of acquisition for new members and products continues to decline, a core indicator of its platform's network effects kicking in. If member growth normalizes and the technology platform's growth slows down, the current premium valuation will become a significant headwind. The $30 high from September represents a psychological barrier that the stock will need a strong earnings catalyst to retest and break. The path to long-term stock price appreciation is not about one segment's success, it is about the sustained synergy of all 3 business segments working together. For example, the Galileo unit recently joined the Amazon Web Service Partner Network, a seemingly small news item, but one that underscores the B2B tech credibility that can create long-term, stable, non-lending revenue. The core question for investors is whether SoFi can continue to grow its profitable niche in personal lending while simultaneously leveraging Galileo and Technisys to establish a deeper moat around its business. Comment below how many shares of SoFi Technologies Inc. you currently hold and what price target you are looking for in the next 12 months. The interplay between aggressive lending and capital-light technology is the most important factor in determining the stock's future. The market expects a high-growth lender, but the reality of a diversified financial tech platform with a bank charter powered by a high-margin B2B software segment offers a much more compelling and defensible story. If they execute on the technology side, the stock has room to run regardless of short-term interest rate volatility. The difference between expecting a volatile fintech lender and owning a surprisingly diversified and increasingly profitable financial powerhouse is the key to holding the stock over the long term. The market's caution, reflected in the low median analyst target, continues to create a tension with the stock's strong momentum grade, suggesting that the street is underestimating the lasting power of the platform effect.